On Tuesday, Nike reported first quarter results that beat expectations on both the top and bottom line. Revenue came in at $11.72 billion versus $11 billion that was expected, and earnings per share landed at 49 cents compared to the 27 cents analysts were looking for. Shares surged more than 7% after the report and are now up 14% since last quarter's earnings. The story here is Nike's turnaround plan finally showing early signs of traction. CEO Elliott Hill has been under pressure to clean up the bloated inventory problem, rebuild wholesale partnerships, and restore momentum to a brand that's been lagging in recent years. Wholesale revenues returned to growth this quarter, a positive signal for investors hoping Nike can get back in the dominant position in sportswear. That said, the turnaround is far from complete. Net income still dropped sharply from a year ago, $727 million compared to $1.05 billion, and revenue only grew 1% year over year. Nike had previously warned of a mid-single-digit sales decline, but while the beat is encouraging, it also highlights how slow the recovery actually remains. Margins are also under heavy pressure. Tariffs costs, of course, are climbing faster than expected, with Nike now forecasting $1.5 billion in added expenses this year, up from a $1 billion estimate made earlier. Since nearly all of Nike's shoes are made in countries like Vietnam, the company remains heavily exposed to shifting trade dynamics. The bottom line, Nike's latest results gave investors a much-needed confidence boost, but tariffs, China weakness, and slower consumer spending are still weighing on the business. Stock's rally shows investors want to believe in the turnaround, but patience might be a long key here.